Are you or someone you love struggling to find a decent home loan interest rate in today's market? With mortgage rates on the rise, finding an affordable option can feel impossible. But what if I told you there's a way to secure a lower rate without turning to traditional lenders? Today, we're diving into the world of family loans, your potential path to a decent home loan interest rate. As of now, the national average rate for a 30-year fixed-rate mortgage stands at a staggering 6.81%, and for a 15-year fixed-rate mortgage, it's 6.13%. These rates can put a significant strain on potential home buyers, but family loans offer a beacon of hope, providing a means to secure lower rates while avoiding some tricky federal tax complications. So, what are AFRs, or applicable federal rates? Simply put, AFRs are the minimum interest rates you can charge on loans to avoid unwanted federal tax side effects. The IRS sets these rates, and they vary depending on the loan's duration. For example, for a loan made in April 2023, the AFRs were 4.86% for short-term loans, up to 3 years, 4.15% for midterm loans, over 3 years, but not more than 9 years, and 4.02% for long-term loans, over 9 years. While these rates are higher than they were a year ago, they're still much lower than commercial mortgage rates. Next, let's talk about how to structure your family loan. You have two main options: term loans and demand loans. Term loans have a specified repayment date, and the AFR for the loan applies throughout its duration. This consistency can be a major advantage. For instance, if you made a $400,000 5-year term loan to help your niece buy a house, you'd charge an interest rate of 4.15%, the AFR for midterm loans at that time. This rate would remain fixed for the loan's duration, providing both you and your niece with stability. Proper documentation is crucial. To ensure your loan is considered legitimate and not a disguised gift, create a written promissory note. Include the interest rate, repayment schedule, and any collateral, like the borrower's home. This not only protects you, but also allows the borrower to claim deductions for qualified residence interest expenses. Without proper documentation, the IRS may reclassify your loan as a gift, leading to potential tax complications. If the loan exceeds $17,000, it could impact your federal gift and estate tax exemption. Charging less than the AFR on your family loan introduces tax complications. The IRS treats this as making an imputed gift to the borrower. Essentially, you have to report the difference between the AFR interest and what you actually charged as taxable income. However, there are two tax law exceptions that can help: the $10,000 and $100,000 loopholes. The $10,000 loophole allows you to ignore imputed gifts and interest if the total loan amount is $10,000 or less. But for home loans, the $100,000 loophole is more relevant. Under the $100,000 loophole, if the total loan amount is $100,000 or less, and the borrower's net investment income is $1,000 or less, you can avoid reporting imputed interest as taxable income. This can be a significant benefit when helping a loved one buy a home. In conclusion, family loans can be a fantastic way to provide better interest rates than commercial lenders. By using the AFRs, you can offer a fair deal without facing tax complications. Just remember to document everything properly and consider the tax implications.